This is Val Hughes of the Value Guys on the Financial Survival Network. Hello everybody, welcome to another edition of the Value Guys Stock Talk Show with Val Hughes,
the cleaning ladies, and Momentum.
And we are 31-year Wall Street veterans who have had to take on secret identities and go underground. I don't think we can do this with that.
It sounds like we're underground.
Underground in order to provide you with our candid views on a handful of stocks that we screen for in the shop here each week. You've seen our faces on TV, you've seen us quoted in the news, but our bosses would never allow our unfiltered views on the air, so we've disguised our voices and they'll never know. This week, it's April 27th, 2012, and we have done a high margin screen. We've screened for high EBITDA margins and have looked through there for some good values. We've got 3 good names this week. But before we get to that, a couple of important caveats. First, this show is for entertainment purposes only. That's not a guarantee. Secondly, Mo and I are professional analysts during the week, and we do a lot of careful analysis, conference calls, management meetings, etc., and we've done absolutely none of that here on the show. We're just kicking back after work. And then third, let's see, I want to get all these in. Our lawyer says to remind you that we may not have your best interests in mind, so do your own work. We may be recommending the opposite of what's best for you. And then fourth, I have been drinking a little bit this week, I have to admit.
Been drinking all week.
Yeah, so there's that. See all our disclosures, caveats, pictures, bios, etc., links to best ideas, all kinds of stuff at www.thevalueguys.com. Okay, so here we are, another exciting week on The Value Guys, and I hear we've got a cleaning lady in the background. So
They start like 1 in the morning.
I don't know. So just fast forward if you want to. We'll try to wait for the good stuff till she's gone.
But, she's down the hallway.
Yeah,
there
but
she goes.
we're on a clock, so I got somewhere to go tonight, Mo. I got to get the show wrapped up.
You have a life.
Yeah,
good.
So do you. What are you talking about?
No, I know.
Didn't you do something exciting this week?
I was. I
did.
was in Europe, and down business, and
right.
what the gossip there is.
I don't know.
Well, we said on the show, I think it was 2 weeks ago, that Apple's market cap surpassed Poland.
Yeah.
So it was bigger than Poland.
And what do they think about that?
They think they're talking about having Apple actually replace Poland in the EC.
Really?
Right, and there is a lot of talk about a conversion of the euro to the Apple.
Ah.
So there's that. You don't hear that when
you lead
in the
interesting
United
lives
States.
over there on your side.
And I was, it was amazing. It was amazing. And then I get back here, another big international story.
Yeah.
Walmart.
Walmart. Who would have thunk, huh?
Bribing people.
I can't
in
believe
Mexico.
it.
Mexico.
I mean, there's no one that's bribing anyone in Mexico,
Well,
let alone Walmart, of all people.
Mexico's probably the most buttoned-down country in the world next to Switzerland.
That's the most honest country I've ever visited.
So, they did a big internal investigation. They found out they were actually bribing people.
That's
so
shocking.
They make the guy the chairman of the company.
Well, probably help the company, I guess, in some way.
So
help
six
reputation.
years. Yep, 6 years have expired. That's beyond the statute of limitations. They find out that they've been bribing Mexican officials. Cheers.
Cheers. Go ahead.
And,
sorry, didn't mean to interrupt there.
So we're all shocked.
I'm completely shocked.
Shocked and appalled. I'm shocked.
I don't know in which order.
So that.
What do you think's going to come of that?
I don't know, but be interesting to see that play out.
They might stop speaking Spanish in Walmart.
Here's our should be a public company idea.
No way.
Yeah, last week, a New York City preschool announced that they are going to begin doing DNA testing of prospective 4-year-olds
to see who the geniuses are going to be?
Well, DNA can actually predict who will be a partner at Goldman Sachs versus a VP.
Oh, my God.
Right? Who's going to be a department head?
Who will be at Barclays versus Goldman? That's important.
That's true. That is in the DNA. So you do that testing. It's a way of ensuring future
maximize the value of your school. That's brilliant.
So we
should do that around here with analysts.
Unfortunately, there are no publicly traded DNA educational testing companies yet.
No.
I think we should raise money,
Yeah.
start one,
Yeah.
and then take it public.
Why don't we do something at
It's going to be huge.
eBay Securities?
When you look
Absolutely.
at how broke colleges are, if colleges did DNA testing, to only procure the best prospective contributors, and you can
That
screen.
is so wise,
Why
Mo.
screen for intelligence when
Yeah.
you can when you can
Screen for
future
contributors, present value.
Exactly.
There you go. Wow.
So-
well, there's a nice finance, theorem that we can
And there's
throw
a
out.
good lead into
Yeah. Okay.
our
Well,
name.
we've got a couple things going this week. We've been doing screens that we run in the shop, and screens really are meant to basically give you an inbox to go through. You got to go through these things. There's no black boxes on the in the value shop. So you're just trying to get something to work on, And so I think we've run a PE screen a couple weeks ago. You can go see that. We're naming the show with the type of screen to help you look through the index there. What else? We did an enterprise value to sales.
Right.
We did an ROA, return on assets, and then ranked by valuation. We did a couple different things. This week, we did a margin screen, EBITDA margin, earnings before interest, taxes, and depreciation, divided by sales. So in effect, it's trying to be a cash flow number before you have to reinvest in, inventories and things like that. Wait a minute, the cleaning lady's here. Hold on. Hello, ma'am. Oh, you want to get the trash? Yeah. Okay, that's fine. Come on in. We're just.
I think it's the first time we've had a guest on the show.
We've never had a guest on the show.
That's a step in the more professional direction.
No, I think so.
Moving up in the right.
Thank you very much. I think we're not quite done with the wine, so we're still working on that. And just bear with us. This will just be a minute. And then I have this, ma'am.
And this is actually a live broadcast. This is not a.
This
is not a simulation. Right. That was a real person there. That wasn't. We weren't using GarageBand to simulate the rustle of the garbage.
We get in here. It's like an airplane cockpit. You really don't expect somebody to walk in here.
Yeah.
But then here it is. All
right.
Especially
since we're so kind of out there in space.
I'm so much more comfortable now. It's so tidy in here now, isn't it?
Yeah.
Okay.
Yeah, looks good.
So, anyway, where was I?
Iconix.
No, what was I? I was talking about the screen. So
yes,
it's an EBITDA margin. It's trying to be a cash flow before contributions to inventories, receivables, things like that, capital spending, all that. But it's kind of a proxy for cash flow.
Let me ask you a question.
Yes, sir.
The first name in the group has got a 66% cash flow margin.
Okay, which is we didn't name the we're going to.
I'm asking you a conceptual question first.
Yeah, sure. Okay.
66%. What's the S&P cash flow margin?
I'm going to have to guess because I don't have that number.
Well, you guessed at everything else.
Yeah, why not? It's entertainment purposes. I'm going to say the S&P 500 EBITDA margin is around 15, 14.
15.
13.
And these companies are 66.
This is 66.
And they're legal.
It's a legal company, yeah. And it came up on the screen. The reason these are high margin is we screened on high margin. That's the beauty of these screens. Why are we looking at this?
There's a concept that's easy to understand.
Why are we looking at this? Well, it's high margin.
All right.
That's why.
So the first guys.
Well, let me name all three so you can fast forward. It's Iconix, ticker ICON. Iridium. No, wait, that's a shout out. I'm sorry. We're doing a couple shout outs. Iridium. That almost made the screen. Number 2, Nson, NSU, which sounds like a Nevada State University logo as well.
Right.
Portfolio Recovery Associates, PRAA. So you can fast forward to your favorite if you want to. First up, Iconix Brand Group.
66%?
Yeah.
What can you possibly do that you would earn a 66% cash flow margin?
Well, I can tell you that. Not actually report the sales. So, for example, if this happens in drug distribution, where drug distributors buy pharmaceuticals from the drug companies, billions and billions and billions of dollars. They take ownership. They sell them and they get like a 3% markup, which makes sense. They're just moving it. They show a gross margin of like 3%, right?
Right.
But then you've got other companies like Express Scripts and these pharmacy benefit managers. They don't take ownership of the drugs. They sell drugs too. but they don't take ownership. And so imagine, instead of reporting 105% profit, you report that 5% as your revenue.
Yeah.
So your revenue is vastly lower, but now you're showing very high EBITDA margins and you're a service company.
Right.
So that's what I think you got going on here. Royalties, service, they're not actually... This company is a... they own brands, and they own a bunch of good ones. That's why I'm interested.
I mean, these guys own, at the same time, London Fog.
Yeah.
I mean, that's about as square as you get. And a fashion name called Mud.
Mud.
You ever wear any of that?
Not on
purpose.
Not
intentionally.
Yeah, no. Well, they've got, Joe Boxer.
Rampage. Sounds like a movie. With
it's all over.
Sylvester Stallone in it.
It looks like a mix of women's wear. Fieldcrest is towels. I remember that. This is just probably a mishmash of failed brands at the original companies. And these guys pick them off. They figure they can organize teams a little more effectively. They can sell a little more effectively. Who knows? But they think, you've seen this one occasionally. They organize these brands, and they're a brand management company. They put these names on everything: clothing, footwear, beauty, fragrance, home, etc., etc. And so they get these giant margins. Yeah. So why are we talking about it? Well, in addition to the great margin, they've got a decent valuation. So as I've said on past shows, if you're a value guy, you don't have to screen on valuation. Screen on the metric that you want, and then look through it and find the cheap ones and the ones that you're apt to like. The thing I like about this is it's brands. So are brands in the ascension or the descension? That's what you have to ask yourself. I think we have a long path, and it's continuing, of brands in the ascension. And, you can punch through.
Is that an astrological sort of thing? Brands in the ascension?
Well, just think, the idea of having your little corner store and it's just Joe's, you need to organize your name, your brand, your image. And so the knowledge of how to create a brand and have its, have a successful impact on the market, I think is a learned skill. And if you have it,
there's a value.
There's some advantage in some fashion, and I think ultimately, there's fewer and fewer private businesses, mom and pops around in most things, and so these guys have this broad list, and it's 7 times EBITDA, which I like. That's, if I flip that over, 1 over 7 is 14% cash on cash return. It's got a high enterprise value to sales, but you would expect that in a high margin business because each dollar of sales is delivering a lot of profit. The price to book is 0.9, and I think, to me, what's interesting about that, Mo, is that book is oftentimes represents what they've paid for these brands. Now, you'd have to go through and look and see if they've written anything off, but we've got all the assets here in front of us, and I don't see any write-offs. Other than most recently, there was a small one, 10%. I don't know, maybe it wasn't due to a loss, so maybe they did have a write-off. But, you maybe really are buying this cheaper than they paid for it.
All right, well, let me ask you a question. Take a look at the EPS expectations.
Yeah.
And 1 week ago, 1 month ago, 3 months ago, the numbers are coming down.
Yeah.
And in theory, we're seeing early stage recovery. So I wonder, what's going on there? I don't know.
Well, I don't know either. Obviously, you got to do your own work. But what often goes wrong with brands that they, cause analysts to downtick their numbers is that they're just not getting the sell-through per foot in the locations. The new thing isn't selling. They've given up some space in some stores. I mean, you'd have to go ask them what that's about. It could be that they're not getting some pricing that they wanted or whatever. But it's not a lot, I would say. It's just ticking down a little bit. And there is a backdrop that is fairly favorable to at least clothing, and these guys do a lot of other things, but to the extent that apparel is a big factor.
And that is that people are always going to be wearing clothes.
Well, they're wearing clothes. The fashion cycles are, they're always faster, but I don't think people pay as much attention to that these days. But no, what I was going to say is cotton prices are falling. So they peaked last year. Cotton got to, I think, record levels. And it's been backing off. And to the extent that they don't have to give up price, they're going to pick up some margin.
Well, you're seeing that 61%, 64%, 66% margin, 68% forecasted.
Yeah.
So that does make some sense.
Another simple metric that looks interesting is it's 9.5 times earnings, and it tends to trade. According to this, the 5-year average is 14. The low is 7, so we're not quite. Don't ever expect to get stuff on the low. That's just luck if you do. And so
leave that to professionals like us.
No, leave it to just being lucky.
Yeah.
I mean, you can't always get it perfectly, but it just it seems cheap. Now, the thing you'd have to go, the work to go do is, have they lost any big customers? That's one. Do they buy licenses from some firms instead of owning them, and they're about to run off, like their biggest selling product, they don't actually own the name, something like that. I don't have any idea. I don't cover this. We don't own this here in the shop. But it certainly is interesting and worth a look because of the valuation. You do have this trend with cotton prices. We've got this little comparable list where they look like the cheapest guy on the list.
And here's a thought, purely from a technical perspective, but in 2010, it's entirely possible on the recovery side. People pretty much knew what your thesis was. Cotton prices are going to fall. You're going to really see some margin expansion. You're going to see a pickup in the retail side. So the stock was up 52% in 2010.
Yeah, had a good year.
And in 2011, it was down 15%. Now it's down another 6%. You know what's happening?
Yeah.
It's growing into its own valuation.
Yeah.
So the question is, if it's fully grown into, these stocks always over-anticipate big news. And then it takes them 2 years to kind of grow into it. If they have, you set a nice kind of technical platform for the stock to start to take off again.
Well, there's another element. I mean, part of the stock movement, I think, is the movement in sales, but there's also been some stuff going on in the balance sheet. So I'm looking at 7 years of history. There's been a consistent increase in the share count the whole way.
Mm-hmm.
So back in 2007, they added big jump, another little jump,
shares,
a little jump, little jump, little jump. So either that's compensation to executive stock, options and things like that turning into shares.
But you know what I think? I think they were in the process of acquiring these brands with stock.
Right. That's a perfect.
Which is how you would. I mean, the company was only formed in 1978. Yeah. They got an awful lot of brands.
No, I think that's exactly right. That's a good point. The other thing, though, that I see is while that stock shares outstanding has been going up, look at the debt number, Mo. They've managed to pay off.
Mm-hmm.
So in 2007, they had $650 million in debt, and they had 61 million shares.
Mm-hmm.
According to this, and again, you'd have to check it, but in 2012, zero debt, and the share count is also zero. So maybe they just don't have that information. Let's go back to 2011. 311 million in debt, down from 650 4 years earlier. So they've got this nice sort of $50-70 million a year debt reduction going on, and they're also, the share count is pretty stable. In a year when the debt came down, so clearly they're not selling stock to pay down debt. They must be generating a fair amount of cash flow. And if you look at the EBITDA numbers, they sort of mirror the decline in debt, at least in 2011. So it appears management has a commitment, just judging by their actions, to get this debt paid down and improve their assets to equity ratio.
One last thing, so we don't overanalyze this, or maybe we'll just do one mega analysis of one company. But here's another interesting thing to look at. If you look at what happened in 2009, share count went from 61 to 68, and then in 2010, share count went up to 75. So a huge outflow of shares. My guess is they were buying tons of other companies, and if you take out the financial crisis, the big decline, and you look at what that stock's done over that whole period, it's been a very, very consistent. Smart for them to use their shares, purchasing good brands. So you have a pretty good long-term from 2006 story. It's working.
Yeah.
So who knows if it's plateaued out and it's ready for another surge? Looks interesting.
Yeah. No, I like it.
We gotta look up what mud is. Maybe we're not wearing the cool stuff.
I don't think we are, Mo. Let's face it. What else is in here? Massimo. I don't even know what that is. Mishka. Bongo. Okay, now candies I know.
Those are the shoes with the
They had an
plastic
ad campaign
heels.
that
Very provocative.
caught my eye a few years ago.
Yeah.
Anyway, okay, what else do we have going on here? Next up.
Nson Resources.
Nson Resources. That's right. Ticker NSU. Why are we doing this one, Mo?
Because they mine gold in Africa.
Gold in Africa.
Yep.
So, again, we're not, picking industries here. This came to us, again, off a margin screen.
Yep.
So,
it's true. And there's some really fascinating. Look at, let me ask you, before we get into the valuation.
Yeah. What's going on?
This is a market cap of 700 million.
Yeah.
Pretty small.
700. Pretty small. Bite size.
Tiny.
Small cap, if you will.
7 analysts.
Something's up with that, Mo.
Well, you know what? Here's what I think. I think the swag is good.
Yeah.
I remember
Sure.
I was an analyst. I wanted to follow the cruise industry.
Yeah.
Because I'd need to do a little due diligence out there.
Oh,
If
sure.
you're following a gold company,
What do you get in the mail, right?
or what do you get when you go to the conferences?
Did you know guys that
gold bars.
That I knew guys that covered Disney for kind of one
They
reason.
got free DVDs and stuff.
I mean, they take you down there every year.
Yeah.
To Disney World, and you bring your family, and it's all expenses, and it was a fabulous time. And Disney had at that time, and I don't follow it.
Is that why you took them so often to Disneyland?
No. But I'm just saying, there were 50 people covering Disney. Do they really need that? Is it that complicated?
No, but it's that much fun.
Yeah. And they would
smart.
just take care of you. And, you may be onto something with that. Mark.
I think the swag's got to be really great.
Yeah.
And there's one last big picture thing.
Like some fireplace tools from these guys.
Really?
Wouldn't that be nice?
Yeah.
I mean, depending on the
real
melting
thing.
temperature. Right.
Steel. And congratulations. I just want to say
Yeah, thank you.
happy 60th.
Yeah. Thank you.
I mean,
Yeah.
6th.
Yeah. It's one of those.
It's one of those. Is it 6th?
Yeah. No.
11th.
It is.
11th. I knew it
Could
was.
be.
11th.
I don't want to say too much.
Happy 11th anniversary, and
thank
you're
you.
supposed to give.
Well, this year it's stainless steel, Mo.
That's what the
Yeah. But
Great.
Thank you. Yeah, she doesn't know anything about that.
Paper, glass,
Yeah,
and
you gotta stay
stainless
traditional.
steel.
Right.
That's good.
Stainless steel. Yeah, 11.
Anyway.
All you 11s. Anyway, we're losing our place.
Sorry, I was
fast forward
right.
through this part.
I was just going to say with Nson, one of the things, big picture, you have to be careful of is the stock was down 26% in 2011, 36% in 2012.
Isn't that just gold coming down in
No,
price?
you know what? Here's one of the big.
We should probably throw up a gold chart.
Here's one of the strategic things you got to look at when you look at these companies. They need to make sure that they pick their warlords appropriately. When you're working in Africa, those guys they can kill enough to stay in power, but not so much that
You don't want to upset everyone.
Yeah, so look at what's happening with Charles Taylor from
Yeah.
Libya. Boom, he's getting, he's
Yeah.
on trial now. And all of these companies that were basing their business model on him, poof. So I don't know. The thing that worries me is down 2 years in a row.
Is that where he was?
No, I'm saying, are these guys in with the wrong warlords in Africa?
They could be. There's not. That's one. You know who you need for that?
Who?
I think U.S. Trust has a division that knows a lot about
Just
that.
looks at because if
Yeah.
these guys are
You
with the
gotta have
right
specialists.
warlords, it's kind of like you want drug companies in the right sector. That's so.
No, that's where you find that. They
But,
know what to do.
Good story.
Yeah.
Tell me, do you like the numbers?
Well, I don't know. It's. Well, here's what I'll point out. I don't know much about gold really. It's got a 78% EBITDA margin.
Geez. Whoa.
I mean, again, that's amazing. It's probably just it's just a fee-oriented structure. So
You should show your wife this and tell her what an overrated commodity gold is.
well, I think what happens is these guys it says here, they explore gold and base metal, they engage in the acquisition, exploration, and development of mineral properties in Africa through its top secret subsidiaries. I just threw that part in, but that's what they do. And so I bet the price of gold, the value of the gold doesn't flow through here. It's sort of a service fee minus costs. And
Which
so
suggests that's a very sustainable margin.
And this might represent their whole revenue of 500 million or 300 million or whatever. It's obviously volatile. Might just be a 1% fee on the value of the gold that's moving through their hands, which would be 300 million. So that would be like 30 billion. Again, if it's 1%,
right?
$30 billion of gold moving through their hands. Which you have a calculator? 30 billion. What's that? 9 zeros. And then gold is 1,000 an ounce or something like that. I don't know what the hell. So that's 30 million ounces of gold. And
how many pounds is that?
Yeah, let's figure that out. I'll multiply that by divide it by 16, right?
Ounces.
Yeah, 16, right? That's 1.9 million pounds.
How many tons is it? Next.
All right, let's. So anyway, here's what I like about it. First, I don't know anything about the gold market. I will note that 3 months ago, all the analysts dramatically reduced their estimates, and the stock went from 7 to 3. So why am I looking at this thing? Well, it came up on this yield screen, but I pulled it out of the pile because it's trading at 1.1 times EBITDA. Mo, that's 100% return. So if you buy this, if they just keep doing whatever the heck they're doing for 1 year, you get all your money back in 1 year. That's a 1 year payback. I mean, if you bought the company, you don't actually get that. But theoretically, the enterprise value, we all bought the company. We'd have to come up with how much would we need? 471 million. So you'd make a few calls, call a couple of desks over in your company there, and we'd pull together a couple things, and we could buy this company, and then we'd be earning 1 times that in 1 year. That's amazing. So I'm attracted to that. Now it could be that,
given what our bonuses are probably going to look like this year, that's even more amazing.
Well, okay, so actually we're up to a pretty good start. I know that the deal flow's not so good. I read something about something bad happening to investment bankers. I hope that doesn't affect your team, Mo. But in any case, we just run money over here, small cap. We're off to a pretty good start. Anyway, 1 times EBITDA. I like that. It's 1.4 times book, so whatever you're buying here, I don't think you write stuff off in gold mining. I mean, maybe you do. I don't know. But it's only a 40% premium on the cost. So once you bring it out, mine it, do whatever you do, I don't understand all that, but that looked pretty cheap to me. And then 5 times earnings. So again, I don't know what happened 3 months ago. Everyone downticked their estimates. Stock 1 times EBITDA.
And they had a decline in sales, and they just might be the investment community pointing out they're going to have a decline. It's happened.
Yeah, all the analysts turned negative. They probably all went to sell. What else could you do? Look at that.
Yeah.
Things fallen. Sales fell a lot. Sales are down a lot, but sometimes
if sales, if you think sales are going to evaporate, don't buy the stock. If you think sales are going to take even just a little bit of a downtick, it's only $3.50.
If let's say you're in a theater, it's burning down. Would you run in to try to get some Twizzlers?
Yeah,
right. Me
I
too.
would, yeah.
So that's what. All right.
There's a lesson there. And if anyone...
Next up.
Yes.
And if there's a little burn, you heal.
Now,
right?
this is what some of your clients wish they had. Portfolio Recovery Associates.
Really, Mom. Really.
PRAA. They hire... kneecap breakers to go after portfolio managers.
No, they don't.
And I was thinking I would hire them to go after and get some of my Lehman Brothers bonds. So
your Limas?
My Limas.
Leave it something?
Yeah, leave it with us and you'll never see it again.
Leewoo. Yeah. Okay, well,
That's not what they do?
No, let me put a little more accuracy in it. I mean, that was a good estimate of what they do, but it's a financial and business services company. They engage in the detection, collection, processing of both unpaid and normal course accounts receivable. So I'm glad they made that distinction, whatever that is. And what? Originally owed to credit, grantors, governments, retailers, and others. So it's a collection agency, right?
Right.
And we are in a period of more difficult credit and a higher, rate of default on various things. And these guys have a nice history of growth. They have not had a down year. Sales are $540 million. We screened on margin, so that's why this thing is coming up.
And as a collection agency, one of the things you look for is these guys have been investigated by the Senate subcommittee on racketeering and illegal activities.
Have they?
Yeah, and if you
What?
are,
Where does it say that?
Well, you have to read it in the fine print,
not
because what's
reading
great
it.
is that if you have been investigated, you know that your collection numbers are going to be much higher than generally than companies that haven't been investigated.
That
may explain the margins.
The margins. I think you've got a fee situation. So 39% EBITDA margins. The net margin here is in the 20s, so I like that very much. And again, looks like you're getting a call. The valuation here is cheap. Now, these guys don't report EBITDA, and I couldn't exactly tell you why, other than interest and that type of thing is part of their business, or EBITDA is really gross margin and things like that. So they may not have a lot of operations. They're just taking a spread, between what they can acquire something at and what they ultimately get paid at. And so, but they do report a net margin of 20. I said that. They have a return on assets that's in the upper single digits to the 10% estimated for this year, and with a little bit of leverage, they're in the mid-teens on return on equity. So that's pretty respectable. The price to cash flow. Now, I don't have all the detail, and I don't know what that is. It's probably just operating cash flow. Is 7 times. So again, you the inverse, 14% cash on cash. PE is on the forward years 10, trailing 12. Again, that's pretty reasonable in an environment with the long bond at 2%. Earnings estimates, there was a big downtick 3 and 6 months ago by about 20%, but we're still looking for an up year, so someone just got a little aggressive.
Did you mention the long-term debt?
No, I did not.
Look at that.
Let's see.
Down $100 million.
Yeah.
Since 2009, that's a good sign.
Yeah, they're paying off some debt. Shares outstanding ticking up a little bit. So again, I don't know, did they acquire somebody? Did they, who knows what that's about. But, I don't know, Mo. It just popped out. It's a margin screen. So we had that, 39% EBIT margin. Yeah.
If they're good enough for the Senate subcommittee on racketeering, they're good enough for me.
I'm not seeing that here.
Oh.
Is that, must be in your copy. Anyway, so that's portfolio recovery. We didn't sound that excited about that one. I don't know. I kind of.
Where are your shout-outs?
And then we had 2 shout-outs. One was LTC Properties, which we've had come up in a couple of past screens. I think, I don't know, maybe enterprise value to EBITDA, something like that. We've talked about this in the last few weeks, and I think we've had some listeners write in and say they enjoy companies that pass more than one screen. Well,
they basically own old age homes.
Yeah.
Which is where a lot of those listeners actually wrote in from.
It could be the very ones that are there, yeah.
Yeah.
And then the other shout-out was, what? You liked one.
Iridium.
Iridium, yeah.
Now, Iridium, this is the cell phone. Now, I have a problem with Iridium. This is the cell phone.
Yeah.
That you can use anywhere in the world. It's, it's like $7 or $8.
Satellite system.
Yeah, it's $7 or $8 a minute. And so if you're in the Nile or in the top of Mount Everest, you use an Iridium phone to make your telephone call anywhere in the world.
Or on Staten Island or something like that.
Here's the problem.
Yeah.
Or where you live, you'd probably need an Iridium phone. But last week, Apple conference call. Apple's pretty much saturated North America. They've saturated Europe. Now they're in the process of saturating the developing countries. They are saying that their next big area are the indigenous tribes of Bongo. North Korea.
Really?
Yes. So
North Korea, really?
But all of these
Places with no wires, no infrastructure.
where you would normally use an iridium phone.
I see.
So
yeah.
possible that they are going to now begin being replaced
with the
Apple iPhones that are basically.
You think they may buy? There's a buyout opportunity here from Apple. Okay.
You know,
well, wow. So you heard it here. Now, I have a question, Mo. Should we do? It's late into the show. We're at the 30. We're very late into the show. We have not yet prepared our favorite segment of the show, walking through national economic trends. Now, should we pause the show and go and do that, or bag it?
No,
do it? Okay.
Do it.
Ladies and gentlemen, hold on. We're going to go spend a little time at the copy machine.
Kill a tree.
Right back. Hold on. Hello, everybody. We're back. And Mo and I have just spent hours combing through this stuff. And so we're looking at national economic trends from April 2012. If you go to the website of the Federal Reserve Bank of St. Louis, all this stuff's free. It's everything you ever wanted to know about the economy. There's also a companion called National Monetary Trends, where the scariest stuff is, and we only do that when there's no children listening, which we did a couple weeks ago.
X-rated show.
Yeah. But we're just paging through. You can go download this yourself, and we try to come up with a couple things each week that might be interesting for those of you that want to hear something interesting. Who knows?
Did you make a smiley face on the interest rate chart?
I did, actually. Yeah.
Is that some sort of a technical something you use in house here?
Well, first thing,
we don't use those.
No, I understand. The smiley face is not widely used. But here, my family's waiting for me. I'm late, so I just a lot of times in national economic trends, I might find something in the back. But here I found something in the front, on the first page, and I was happy about it because we can. I got to get going. Yeah, my wife just she needs me home. Anyway, the thing I would note is that the 10-year Treasury just ticked up, and the reason that's noteworthy is that it had just only really been ticking down for about a year. It did have one quick uptick, back in the fall. But it's now off 2%. So what does that mean? Well, if the price of money goes up, it means the demand for money is probably going up. And the reason that's good is it means people feel like they have something to do with it. And that's a change from everyone kind of moping around thinking they have nothing to do with it.
Or it could be early onset inflation.
Well, it could be.
For which there is no known cure.
Well,
let's hope that's not what it is.
We're taking the cure right here,
exactly.
Mo. But it could be, it could be that. It could be anticipation of that. Okay, we're paging through. We should get some theme music for paging.
How about page?
What do you have? Page 7. Wow,
it's a rant.
You've paged really. You have a rant?
It's a rant.
Okay, sure.
All right. Interest rates since 1987.
Yeah.
Okay, so it's been bouncing along the bottom line. We were talking about this before at the break. It's been bouncing along at the bottom line for between 0.0001 and 0.000001. How do you show those changes every week on a graph like this?
Well, that should get taken up with the protocol department, definitely.
Update the graph. Yeah. Hey, just a shout out to the Federal Reserve. You guys, get on the ball.
Or maybe have like a zoom in on this part that just showed 0 to 0.1, and they could find
because that little part of the graph.
Yeah.
I can't. It's just, why reprint the same thing every single week? Anyway, end of rant.
Okay. Well. Okay, here's one I have. I'm going to go because you jumped to page 7. I got to jump back to page 6.
Ooh.
Now, in page 6, and we haven't talked about this before on the show because it gets a little tricky. Okay, but they break up GDP, gross domestic product,
into the G and the D and the P, and three components,
all the letters.
Yeah.
So you have final sales, consumption, fixed investment, government, net exports, changes in inventory, and residual, which I think means fudge factor.
Yeah.
That's how I used to have a residual in one of my models.
Yeah.
Okay, and what I would note is, the buzz of late has been that, GDP kind of slowed down, things are slowing down, employment's slowing down. Well, here's what I'm going to say to that, ladies and gentlemen. A lot of times you have people reporting first quarter, and it's always a seasonally adjusted number, right? Seasonally adjusted. And what I'm going to suggest to you, ladies and gentlemen, is that just means it's wrong. Because when you seasonally adjust, what are you doing? You're taking the average season over the last 20 years, and you're adjusting your data to correspond to the average season. But guess what you never have? The average season. It's always a different. So I don't like the seasonally adjusted number Q4 to Q1 or any Q to any other Q. I like actual numbers.
Unseasoned numbers.
Unseasoned.
Yeah.
Completely unseasoned.
And organic.
Year over year.
Yeah.
Because I think last year at the same time has more in common with this year than last quarter. So with that, I'm going to say final sales in the first quarter of 2012, and this is just simply one of the components. Yep. It's the F component of GDP, right. The FS, final sales. It was 1.61%. That's annualized, of course. That means divide that by 4 if you want to know the real number. And last year, it was 0.04.
Big improvement.
Big improvement
right.
Year over year. The other number, consumption. Last year, 1.47. This year, 2.0. So that's up 30%. Residential investment. Obviously, kind of a big drag on the economy.
But a big driver when it picks up.
Yeah,
right.
And so last year, it was a slight negative contribution. This year, 40 bips. And if you look, that's basis points. And if you look, well, there was a number back here, but it's the second highest number on the page. And then the other, I'll just throw out one other one, and that is government, which has been a drag on GDP for every number on this page, 7 consecutive quarters. But last year, the federal government was an 82 basis point drag. This quarter, only 0.46. 46.
Like,
getting
move into
better.
The election cycle. I think I'm going to see that
and the same with
more.
State and local. So we're just walking through national economic trends. GDP, the pundits saying one thing, values saying another thing.
Yep.
Looking good.
We know we're right, too.
Okay. What else you got? Is that it?
No. How about page 9?
Page 9. Okay.
Top right-hand side.
Oh, I love this
Oil,
one.
natural gas. I don't follow this industry, but I just saw in the New York Times today that this guy McClellan, who created Chesapeake Energy, it was basically a land grab sort of scheme that turned into an oil and gas company, but mostly gas. Stock's getting pummeled. The guy's probably on the way out. And I didn't realize how bad. Look at this chart. I didn't know that.
Yeah.
Natural gas futures in 2008 were $55 per million BTUs.
Yeah.
What does that look like? It's going down to 4?
Yeah. Well, natural gas prices, all this...
I knew they were down. I didn't know they were down
this
that
fracking.
much.
Well, I mean, we have some we have a couple of coal plays here in the shop, and they've been pummeled. I mean, they're down 70%, 1 year. We've actually, we've added a little bit. It's taken the opportunity to improve our quality, but... we were looking at some arch coal recently because, ultimately, coal still is the cheapest way to make electricity. India and China are not yet at that Maslow's hierarchy of needs level where they're as worried about the environment as we are because they still have people that don't have running water and things like that. So, gas here in America has really pummeled coal.
Probably good for the economy because as the price of gas goes up in your car, the price you're heating your house goes down a little bit this winter.
Well, the other thing I saw on this, is that Dow Chemical, I think it's Dow, I read in the paper last week, is building a big manufacturing plant for, I believe, insecticides and such, or fertilizer, but in America, and that's been a long time. The next wave of manufacturing, if these gas prices stay down like this is a local market. This is only happening in America. Oil, that's a world commodity. Gas is specific to where you can get it in these pipelines. We're doing the fracking. America right now has a giant edge in energy because of these gas prices, and the next wave of manufacturing could happen here.
And who knows if it becomes a big export.
Yeah, right. Yeah.
So,
okay, anything else? No?
Page 13. Let me ask you
13,
a
let's
question.
finish it up.
So you circled it too.
I did. What?
But it's not a smiley face. It's see, look at this. We have matching circles.
Oh, yeah. How
Right?
about that?
Real disposable personal income.
Yeah.
My circle is actually, I think,
Much more circular.
Yeah, it's better looking.
Yeah.
Anyway,
Why
what do you think?
did I circle that?
I did too. There's a 2 down
Well,
quarters in a row.
2 down in a row.
We haven't seen that since early 2011.
Yeah. I would note, look at the scale, though. It's down percent change, 0.2%.
I know. But
So-
assuming but it's just you look at 2.
Yeah,
Is that
I mean,
months?
Yeah, I think so. But if you have $1,000 and you're down 0.2%, that means you're down $2 on 1,000.
All right, fair
So
enough.
I
fair
don't
enough.
know. I don't know exactly what that.
This is the way.
I hope it's noise.
Right.
honestly.
This is the way people feel. Real disposable personal income is probably correlated with like how comfortable are you financially. So when those two numbers go down, you think, ooh, pain and suffering.
Well, here's what I actually also thought about that.
Mhm.
Wall Street bonuses
down.
and down enough to affect this number. I mean,
Yeah.
when the street's not paid.
Oh, trust me. Do you know what?
These numbers change.
We have to go. We're going to NetJets. We can't even
You
afford
can't
to
have
fly our own.
You have to rent jets
It's-
now. How embarrassing!
If it wasn't, you know what though? If it wasn't everybody, it would be
At
humiliating.
least you may have a chance to meet Warren. So.
Yeah.
Anyway, ladies and gentlemen, thank you so much for listening in this week. It's been another 50 minutes with the Value Guys. So thanks for that. We enjoy doing these shows. So I guess it's a fair deal.
Did you notice the cleaning ladies?
Yeah, she liked it.
She came back with 5 of her
Did
friends.
she?
They
Oh,
were
yeah,
sitting
they're hanging out
outside.
there. Hey,
There they
hi,
are.
Josephine.
Hey.
How are you? So we've got some groupies in here. So anyway, see all our caveats, indexes to past shows, pictures our moms took, etc. at www.thevalueguys.com. And thanks for listening in, everybody.
Have a good weekend.